Now that we've looked through some of the concepts relevant for the buy-sell, we're actually going to go through some buy-sell arrangements, some possible buy-sell arrangements, kind of step by step. In order to get us started then, we need a sample company. So this is the sample company with which we will work. We'll work with an incorporated company here, ABC Corp, although I will address some issues relevant to an unincorporated business. We'll have Steve and Jill as the only two owners of ABC Corp. Steve and Jill deal with each other at arm's length. They are not married to one another. They are not one another's child. They deal with each other truly at arm's length. And each of Steve and Jill have a 0 ACB for their shares. That's pretty normal. Most business owners will have a relatively small ACB or a nominal ACB for the shares that they own in their business. The cross-purchase agreement, or sometimes called the crisscross agreement, is generally considered the simplest, the most straightforward of the buy-sell arrangements. It is the easiest one to understand. It's also the one that generally gives the least tax efficiency. In a cross-purchase agreement, each business owner will personally own the insurance on the lives of the other business owners. So Steve, in this case, would own insurance on Jill's life, and Jill would own insurance on Steve's life. For the sake of simplicity, keeping in mind we have a company worth $2 million here, that means that Steve's shares are worth $1 million and Jill's shares are worth $1 million, both of them being 50% shareholders. So Steve would own probably $1 million worth of insurance on Jill's life, and Jill would own probably $1 million of insurance on Steve's life. Of course, the amount of insurance that we're using in a buy-sell can be tricky. We may want to buy larger amounts of life insurance or larger amounts of insurance in order to take care of possible future increases in the valuation of the company's shares. Now, for the purpose of our example, Jill dies. Don't worry, Steve will get his chance later. The death benefit in that case is paid directly to Steve. Steve was the policy owner and presumably the beneficiary of this life insurance policy. Section 70 of the Income Tax Act calls for Jill to include then a $1 million capital gain on her death. That is, her terminal tax return will show a $1 million capital gain. That's a deemed disposition of the shares she owned in that company. That may be offset by a lifetime capital gains exemption if the lifetime capital gains exemption is available. That is, if we haven't jeopardized the lifetime capital gains exemption through doing business outside of Canada, or having one of the shareholders retire outside of Canada, or having too many passive assets, or something of that nature. So now that we have the cash in place, that is, we have a death benefit that's been paid to Steve, Jill's shares have been disposed of on her terminal tax return. Because of the deemed disposition on her terminal tax return, all the taxes have been paid. Her shares will now have an ACB of $1 million. That is, the ACB is now equal to the fair market value. So there's no further tax consequences as long as any disposition happens at a price of $1 million. And the buy-sell agreement fixes the price at $1 million, presumably. So Steve takes the $1 million that he received as a death benefit, and he buys the shares from Jill's estate. Steve now owns all the shares. He owns $2 million worth of shares. He would have an ACB of $1 million because he's used the after-tax proceeds of the life insurance policy to make that purchase. So there are some upsides and some downsides to this arrangement. It's very simple. It's easy to follow. There's nothing complicated. It increases the adjusted cost base for the surviving shareholder. In the case we just talked about, Steve ends up buying those shares, and instead of having a 0 ACB, like he had before the whole thing started, he has $1 million ACB afterwards, which will reduce his future tax liability related to the ownership of the shares in this company. It works well in partnerships and other non-corporate scenarios where we don't have another possible entity that could own the insurance. There are some downsides to this arrangement. It's fairly inefficient from a tax perspective. First off, we're using personal dollars rather than corporate dollars to pay for the insurance. That's more expensive than it needs to be. Second, if Steve and Jill have different levels of insurability, if Steve is very healthy and Jill is unhealthy, or vice versa, then Steve is really paying for Jill's health and Jill is paying for Steve's health. That may not be considered a fair arrangement. And then a third factor that makes the cross-purchase agreement potentially not the best is if you have more than 2 participants. So if we have 3 or 4 or 5 people, then you have to buy multiple policies. If you have 3 people and you're using a cross-purchase agreement, you would have to have 6 policies in place in total. Each shareholder would have to buy a policy on each of their other 2 partners. So it's not the most efficient way to do things, but it is the simplest.